Countdown to zero silver. Only 74 trading days left. Shanghai premium explodes to 14.6%. 74 trading days. That is the number quietly circulating among a small group of commodity analysts. A countdown that almost nobody in mainstream finance is discussing openly. Because if the current pace continues, the registered silver inside the COMEX vault system, the metal that actually backs futures delivery, could approach something the modern market has never witnessed before. Zero. And while headlines focus on interest rates, oil prices, and geopolitical tensions, a different signal has begun flashing deep inside the global metals market. In Shanghai, buyers are paying a 14.6% premium for physical silver, not for paper contracts, for metal. So the question serious investors are beginning to ask is simple. If physical demand keeps accelerating and vault inventories keep shrinking, what exactly happens when the market that prices silver runs out of silver to deliver? Welcome to Financial Crisis Explained. This channel exists for people who prefer data over headlines and analysis over noise. And if someone watching today has seen a few market cycles, perhaps understands that quiet signals often matter more than loud ones, consider subscribing to the channel, not for entertainment, but for clear economic briefings like this one. And before we begin, write in the comments where you're watching from, because moments like this tend to matter everywhere. 74 trading days. That number did not appear in a headline. It did not come from a press conference or a government report. It emerged quietly from a set of numbers that most investors rarely examine. The daily inventory reports of the COMEX Silver Vault system. For decades, these reports have existed in the background of financial markets. Analysts follow them, institutions monitor them, yet the broader investment community rarely pays attention. Price charts dominate attention. Economic headlines drive discussion. Meanwhile, the physical metal supporting the entire silver futures market continues moving silently in and out of vaults. But recently, the pattern inside those vault reports has begun to change. Over the past several months, the amount of registered silver held inside the COMEX system has been declining at a pace that experienced commodity observers find increasingly difficult to ignore. The withdrawals are not dramatic enough to dominate financial news cycles, yet they are steady enough to create a visible trend. And trends, not headlines, are what professional market analysts focus on. To understand why this matters, it is necessary to understand how the COMEX vault system functions. The silver stored in these vaults is divided into two primary categories, eligible and registered. Eligible silver refers to metal that meets exchange standards but belongs to private owners. It is stored inside the vault network but is not automatically available for delivery against futures contracts. That metal may remain in storage indefinitely unless its owner decides to convert it into registered inventory. Registered silver serves a different role. This category represents the metal that is officially designated to settle futures contracts when traders request delivery. When a participant holding a silver futures contract chooses to take possession of the metal instead of settling financially, the silver must come from this registered pool. In simple terms, registered inventory represents the immediately deliverable supply within the system. For many years, this structure operated comfortably. The amount of registered silver held in vaults was large enough to accommodate the relatively small percentage of contracts that resulted in physical delivery. Most market participants preferred financial settlement, and only a minority ever requested the metal itself. As long as that behavior remained consistent, the system functioned smoothly. But the balance begins to shift when delivery demand increases while registered inventories decline. Over recent years, the registered category has shown a gradual downward trend. The numbers fluctuate week by week, yet the overall direction has been clear. Less deliverable silver remains inside the vault network. When analysts began projecting the current rate of decline forward in time, a theoretical estimate emerged. If the present pace of withdrawals continued unchanged, the registered inventory could approach extremely low levels within approximately 74 trading days. It is important to recognize that such projections are not predictions. Markets rarely move in straight lines. Additional metal can enter the system, delivery demand can fluctuate, and institutional strategies can change quickly. However, projections reveal something important. They expose structural pressure long before the market reacts to it. At the same time that registered inventories have been shrinking, the number of futures contracts standing for delivery has occasionally shown signs of increasing. Each delivery request requires actual metal to leave the registered supply and move into the possession of the buyer. Every delivery slightly reduces the buffer that protects the system. Under normal circumstances, this reduction does not create concern. The vault system historically maintained a comfortable margin between available metal and delivery demand. But when that margin begins to narrow, confidence becomes increasingly important. Confidence that additional metal will enter the vault system. Confidence that most traders will continue settling financially. Confidence that the futures market will never face a moment when too many participants simultaneously request physical delivery. This quiet tension is what experienced commodity analysts are now observing. The global silver futures market represents an enormous financial structure. The value of contracts traded regularly exceeds the amount of metal physically stored inside the vault network by a significant margin. For decades, this structure functioned without disruption because delivery demand remained relatively small. The system assumes that behavior continues. But if market participants begin changing their preferences, if more traders decide they want the metal rather than the contract, the mathematics of the market begins to look very different. This is why the 74-day projection has attracted attention among serious observers, not because anyone expects the vaults to literally reach zero on a specific date, but because the shrinking inventory highlights a growing imbalance between paper claims and physical supply. And when commodity markets reach a point where that balance becomes uncertain, the consequences rarely remain confined to data reports, because eventually someone asks a very simple question: where exactly is the metal that backs the contracts? And when enough participants begin asking that question at the same time, the silver market may be approaching a moment that modern financial history has never had to confront before. Before anyone can understand why shrinking vault inventories matter, one uncomfortable fact must be acknowledged. The global silver market is not primarily a metal market. It is a contract market. Every trading day, billions of dollars worth of silver changes hands across financial exchanges. Charts move, prices fluctuate, and analysts debate supply and demand. Yet most of this activity involves instruments that represent silver, not the metal itself. At the center of the system sits the COMEX futures exchange, the mechanism that effectively determines the global reference price for silver. A futures contract is simple in theory. It represents an agreement between two parties. One agrees to sell silver at a specific price on a future date, while the other agrees to buy it. The contract standardizes the quantity and delivery terms so that traders can easily buy and sell these agreements in a liquid market. But what makes futures markets powerful also makes them structurally unusual. The vast majority of traders entering these contracts never intend to receive silver. Instead, they use futures contracts as financial tools. Hedge funds speculate on price movements. Mining companies hedge production. Institutional investors adjust portfolio exposure. Traders enter positions, exit positions, and roll contracts forward before delivery ever becomes relevant. Because of this behavior, the total number of silver contracts traded often represents far more metal than physically exists inside exchange vaults. This structure is not accidental. It is the foundation of modern commodity markets. Futures exchanges were designed to provide liquidity and price discovery, not to function as warehouses distributing metal to thousands of traders. Under normal circumstances, the system works smoothly. Only a small percentage of contracts ever reach the stage where physical delivery becomes necessary. When that happens, the metal is transferred from registered inventories inside exchange-approved vaults to the buyer who requested it. The majority of contracts, however, are simply closed out before that stage. The key word here is majority, because the system assumes that delivery demand will remain relatively small. To understand the scale of this imbalance, analysts often examine what is known as the paper-to-physical ratio. This ratio compares the amount of silver represented by open futures contracts with the amount of registered metal actually available for delivery. The numbers can appear surprising to those unfamiliar with commodity markets. At times, the paper exposure in silver has represented dozens of ounces for every ounce of registered metal inside the vault system. Again, this is not considered abnormal within futures markets. As long as traders continue settling contracts financially, the physical inventory does not need to match the full scale of trading activity. Confidence holds the system together. Confidence that traders will continue behaving the way they always have. Confidence that financial settlement will remain the preferred outcome. Confidence that the vault system will never face a moment when too many participants simultaneously ask for the metal. For decades, that confidence proved justified. Even during periods of intense market volatility, financial crises, inflation scares, currency instability, the number of traders requesting delivery remained manageable. The vault inventories fluctuated but rarely approached levels that raised systemic concerns. But in recent years, subtle shifts have begun to appear. Industrial demand for silver has expanded as technologies such as solar energy, advanced electronics, and battery manufacturing consume increasing quantities of the metal. At the same time, some institutional investors have grown more interested in holding physical assets rather than financial representations of them. This does not mean the futures market is failing. It means the balance between paper contracts and physical supply may be tightening. When more traders stand for delivery instead of rolling contracts forward, registered inventories begin to matter more than they did before. Every delivery reduces the available buffer that protects the system from sudden demand shocks. If that buffer becomes thin enough, the market enters a different phase. Prices are no longer driven purely by financial speculation or macroeconomic expectations. They begin to respond to something far more fundamental: the availability of the underlying commodity itself. This is why experienced commodity observers have begun paying closer attention to the vault reports rather than just the price charts. The futures market can trade enormous volumes of silver contracts every day, but when the moment arrives where someone actually asks for the metal, only the vault inventory can answer that request. And if the amount of metal available continues shrinking while the volume of paper contracts remains massive, then the silver market may soon confront a question that futures markets were never truly designed to answer. What happens when a market built on promises is suddenly forced to deliver? There is a quiet rule that governs global commodity markets. When the same asset trades in different regions of the world, price differences rarely last long. Traders move quickly to exploit them. Metal flows from cheaper markets toward more expensive ones. Arbitrage closes the gap, restoring balance between supply and demand. Under normal conditions, silver follows this rule with remarkable efficiency. Prices in London, New York, and Shanghai may differ slightly due to currency movements, transport costs, or trading hours, but large premiums rarely persist for long. Global markets are simply too interconnected. Yet recently, something unusual has begun appearing in the data. While Western exchanges continue pricing silver through futures markets and financial derivatives, buyers in Shanghai have been paying substantial premiums for physical metal. At one point, the premium hovered around 13.5%. Then it climbed 14%, then 14.6%. For professional commodity analysts, numbers like these immediately raise questions, because a premium of that magnitude does not emerge from speculation alone. It usually reflects one simple reality. The buyers in that market are competing for actual metal, not contracts. The Shanghai Futures Exchange operates differently from Western commodity exchanges in several key respects. While futures contracts still exist, the culture of the market places a greater emphasis on physical settlement and metal ownership. Industrial buyers often use the exchange as a mechanism to secure supply rather than simply hedge price movements. Manufacturers, refiners, and state-linked entities participate with a direct interest in obtaining silver itself. In other words, the Shanghai market is closely tied to real industrial demand, and that demand has been expanding rapidly. Silver is no longer just a precious metal associated with jewelry or monetary hedging. Over the past decade, it has become a critical component in several high-growth industries. Solar panels require silver paste to conduct electricity efficiently. Advanced electronics depend on silver's conductivity. Electric vehicles use it in a wide range of circuitry and power systems. Even emerging battery technologies incorporate small but essential quantities of the metal. Each individual application may require only a fraction of an ounce. But when multiplied across millions of units produced every year, the demand becomes substantial. Asia sits at the center of much of this manufacturing activity. China, in particular, has invested heavily in solar energy infrastructure, semiconductor production, and advanced manufacturing systems. As these industries expand, so does the need for reliable supplies of key industrial metals, including silver. When demand rises faster than supply, markets normally respond through price adjustments. But the mechanism for that adjustment depends on where the price signal originates. In Western markets, price discovery is dominated by financial trading. Futures contracts, algorithmic strategies, and macroeconomic expectations influence price movements every minute. In Shanghai, the signal often emerges from buyers competing for physical material. When those buyers begin paying significant premiums above the international benchmark price, it suggests something important. The local market may be experiencing tighter supply conditions than the global pricing system reflects. Under normal circumstances, this difference would trigger arbitrage. Traders would buy silver in markets where it is cheaper, transport it to Shanghai, and sell it at the higher price. This process typically brings prices back into alignment. But arbitrage requires several conditions. The metal must be available, transport must be economically viable, and inventories in the exporting market must be large enough to absorb the outflow. If those conditions weaken, price gaps can persist longer than expected. This is where the east-west price divergence begins to intersect with the shrinking inventories inside the COMEX vault system. If Western exchanges are experiencing declining registered silver inventories, while Asian markets are simultaneously paying increasing premiums for physical metal, the situation begins to look less like a temporary pricing anomaly and more like a signal of structural tightness in the global supply chain. In that environment, the premium in Shanghai becomes more than just a regional curiosity. It becomes a window into the physical side of the market, a signal that somewhere in the system, buyers are willing to pay significantly more than the global benchmark price, simply to secure the metal. And when physical premiums begin to diverge from paper prices, experienced commodity observers recognize the pattern. Because historically, those divergences tend to appear shortly before the market is forced to confront a difficult question. Which price truly represents silver's real value? The one determined by financial contracts, or the one paid by buyers who insist on taking the metal home? Commodity markets rarely move in isolation. Behind every price chart sits a network of geopolitical decisions, energy flows, industrial supply chains, and institutional strategies. Most of the time, these forces remain balanced enough that markets function predictably. Supply meets demand, prices adjust gradually, and global trade continues moving. But when geopolitical tension rises, the behavior of markets can begin to shift. Not suddenly, quietly at first. Investors who manage large pools of capital often begin adjusting their strategies before the broader public notices anything unusual. They reduce exposure to fragile financial instruments and increase allocations to assets that hold value under uncertainty. Historically, this transition has often involved commodities, particularly energy and precious metals. Recent geopolitical developments have introduced a new layer of uncertainty into the global economic system. Rising tensions across strategic regions of the world have increased concerns about the stability of critical shipping routes and energy corridors. Among these routes, few are more important than the Strait of Hormuz. This narrow waterway sits between the Persian Gulf and the Arabian Sea, forming one of the most vital energy arteries on the planet. Roughly 1/5 of the world's oil supply passes through this corridor every single day. Tankers carrying crude from Saudi Arabia, the United Arab Emirates, Kuwait, and Iraq rely on its open passage to reach global markets. Any disruption to this route has immediate consequences for energy prices. Energy markets are extremely sensitive to geopolitical risk because modern economies depend on stable fuel supplies. Even the perception of instability can send oil prices sharply higher. When energy costs rise, the effects ripple outward across the global economy. Transportation becomes more expensive, manufacturing costs increase, inflation pressures begin to build across multiple sectors. For institutional investors, this environment introduces two simultaneous risks: economic volatility and currency instability. In response, capital often flows toward tangible assets. Gold has historically served this role as a monetary hedge, but silver occupies a unique position. It functions both as a precious metal and as an industrial input. During periods of geopolitical stress, it benefits from two overlapping forces: investment demand and industrial necessity. This dual role can amplify market pressure. If geopolitical uncertainty drives investors toward physical metals, while industrial demand continues expanding at the same time, the supply chain can tighten more rapidly than many analysts expect. The connection between geopolitical tension and the silver market may not appear obvious at first glance, yet the relationship becomes clearer when viewed through the lens of global supply networks. Energy disruptions influence mining costs, transportation logistics, and manufacturing output. Political instability can delay shipments, increase insurance premiums for cargo vessels, and complicate international trade agreements. Each of these factors introduces friction into the movement of commodities around the world. Silver, like many industrial metals, depends on a complex network of mining operations, refining facilities, shipping routes, and manufacturing hubs. When geopolitical stress affects any part of this network, supply flows can become less predictable. At the same time, institutional investors often interpret geopolitical instability as a signal to diversify into assets that exist outside traditional financial systems. Physical commodities fall into that category. Unlike financial instruments, they cannot be printed or digitally expanded. Their supply depends on physical extraction, refining capacity, and transportation infrastructure. When geopolitical tension increases demand for tangible assets, the physical market begins to feel the pressure first. This is why some analysts believe that the tightening conditions in the silver market may not be the result of a single factor. Instead, they may represent the convergence of several forces operating simultaneously: shrinking exchange inventories, rising industrial demand, increasing physical premiums in Asian markets, and a geopolitical environment that encourages capital to seek safety in real assets. Each of these forces alone might not be enough to disrupt the market. Together, they create a situation where the margin between supply and demand becomes thinner. Much thinner. If that margin continues to shrink while the global futures market still trades enormous volumes of paper silver contracts, the system may eventually face a moment where the physical side of the market asserts itself, not gradually, but decisively. And when that moment arrives, the question confronting the silver market may no longer be about price volatility or trading strategies. It may become something far more fundamental: whether the global pricing system for silver is anchored to financial contracts or to the metal itself.